What's up, Mortgage Coach community? We have a very special interview today with Mitch Kider. For any executive or leader on this call, probably know who Mitch Kider is, the oracle of compliance law, and likely your company has a relationship with him. If you don't, you should. But for all you loan officers, you're like, who's this Mitch Kider guy? This is who is the top compliance attorney in the country. I've interviewed him a number of times, and not only is he a great attorney, but he's just a great human being. Mitch, it's been too long since I had you on here, but good to see you, brother.
It's great to see you too. It's been a little while, but you know, I love talking to you. I love talking to the Mortgage Coach community.
Yeah, well, it's a tough time in the industry, as we both know, and I don't think anybody deals with more executive teams than you do around, you know, what are the problems in the marketplace. But I always like to focus on what are the opportunities in the marketplace. So first of all, why don't we start with just, you know, what do you think are some of the biggest problems that also are creating some real opportunities?
Well, I mean, the problems are, you know, the problems are interest rates have gone up. The problems are we're trying to fight inflation and trying not to land right smack in the middle of a recession. And all of those things are really bad for this particular industry. That's what the problems are. The problem is we have a lot of people chasing after few loans. And you know, the mortgage industry hasn't been used to this for a very long time. You know, especially the last couple of years coming off the great years that it had. So there are a lot of issues here, but you know, you and I have seen this before. We've been through many cycles, and the mortgage industry has been through many cycles in the last 3-4 decades. So we'll make our way through that too. You know, you ask about opportunities. You know, listen, times are really tough. No doubt about that, Dave. But if you look, you're going to find opportunities. You know, there are opportunities out there. There are sales opportunities out there. Okay, not every mortgage loan needs to be a 30-year fixed rate mortgage loan. There are a lot of different products out there that people are looking for today. They're looking for ARM loans. They're looking for HELOCs. I played golf with a guy that owns a mortgage company in Maryland just the other day, and he told me that, you know, his HELOC business is just booming. It's just booming, and he's doing quite well on that. There are other types of opportunities like buy downs, you know, seller buy downs, lender buy downs. You got to be creative in this marketplace. And sometimes you've got to, you know, make these recommendations to your clients and to others, because some of them are, you know, people that are trying to sell these properties are grasping at straws sometimes as well. So, I mean, there are a lot of opportunities out there, and they're long-term opportunities. You know, what people seem to forget in a marketplace like this is the need to constantly work on your relationships and build new relationships as well. And, you know, what everyone should recognize is that the relationships you build today are going to pay off for you big time tomorrow. So there's a lot that can be done.
Well, you brought up a really key point, because I think, you know, one of the biggest opportunities is to pick up market share, you know, and that's a combination of having a lot of conversations, making a lot of calls for all you loan officers, but it's also a combination of having the right conversation. And one of the things with the Mortgage Coach total cost analysis is we make it really easy to show buy downs and help really bridge the affordability gap. Where are things at from a compliance standpoint? Because for a long time, you know, you and I have always advocated, you know, be consistent with that experience, you know, make sure every borrower is getting consistent value at the point of sale. Mm-hmm. But now that point of sale experience, it's more complicated because you have to show buy down strategies, 2-1 buy down, seller 1 buy down. Where are things at from a compliance standpoint? Have they loosened up on wanting to have a consistent experience? Is it tighter? Is the risk level difference in this market than it has in different markets?
So the answer to all of those questions is pretty much no. They haven't loosened up on the requirements. They haven't loosened up on the fact that they want you to be consistent. You know, what you're really trying to avoid over here is disparate treatment. That's what you're trying to avoid when you talk about this particular issue. And so, how do you avoid this treatment? When you go out there and you're talking about rates and you're talking about things along those particular lines, you have to be consistent. But I mean, are buy downs a problem from the compliance perspective? No, they're not a problem from a compliance perspective. The issue that you have is some lenders are doing buy downs themselves. Many sellers are doing buy downs. I mean, that's how home builders are staying in business today, by doing those particular buy downs. And you have other consumers that, may not have the benefit because they don't have a third party. They don't have someone else that's going to step into that particular role and buy that down as well. So obviously there's going to be some inconsistency that's out there. There's going to be some inconsistency in what you quote based on their facts and based on their circumstances. And that's okay. That's okay, as long as there's a legitimate business reason for that inconsistency.
So lenders, I hope you heard that. I mean, consistency is still as important as ever. Disparate treatment, excuse me, is still a biggest risk as ever. And now you have the best opportunity to get your loan officers to actually use a mortgage coach total cost analysis, because it's the right thing from a compliance standpoint. And it's the best thing when it comes to educating families. I actually had a president of one of the largest mortgage owned home builder, or a mortgage company owned by a home builder, because they were saying like, hey, it's harder than ever for us to keep people under contract. Like we're having more fallout than ever, and we really need to have a more educational experience for consumers so that, hey, we keep them under contract, they don't fall out. And and their number one tactic is showing buy down options and showing seller concessions. So sounds like good sales is also good compliance.
No, that's exactly right. That's exactly right. And good sales also involves educating the consumer. That's really what it's all about.
So what are some of the biggest compliance risks and issues for loan officers and lenders in today's market? It's December 2022, and going into 23. What are the top topics for Mitch Kider?
So, the top topic is fair lending, and has been for a long time, certainly has been with this administration, but has been in the past as well. And so when you're talking about loan officers and you're talking about fair lending, you need to look at a couple of different things. Loan officers oftentimes are given some discretion, some pricing discretion, to make pricing exceptions. And that's an area that regulators, especially the CFPB, is taking a real hard look at right now. So you've got to be careful. You got to be careful along those particular lines, to make sure that you limit the discretion that's out there. Okay, not abolish it, but make sure it's within certain parameters and certain limitations. And that when that pricing exceptions are in fact made, that you can document it and document the reason for it, because you're going to do a comparative analysis with someone that may not have gotten that particular pricing exception. So that's one thing. Loan officers need to expand their reach. In all honesty, everyone's reading about and calling up and asking questions about redlining cases, because they know I handle a lot of those cases, both before the CFPB and before the Justice Department. Well, modern day redlining today is really about, what's your outreach into underserved census tracts, into majority minority census tracts? Are you looking for business there? Are you getting business there? But are you looking for business there? Are you advertising there? Are you going into the community? Are you doing things along those lines? So that's a big fair lending issue as well. And then another big fair lending issue that really kind of has hit the industry pretty hard is appraisal bias. And, you've got to look out for appraisal bias. Now, listen, when you as a loan officer has a consumer that gets a low appraisal, and that consumer, they need to know what they can do about that. In other words, what is your company's process for reconsideration of value? Who do they take that request to? Who looks at that request, and where does it go from there? And that's something that regulators are looking for as well. The other compliance area, Dave, is something that you and I have talked about and with the mortgage coach community for years, and that is, don't forget about RESPA. You know, that 45-year-old statute that governs all your relationships with your referral sources. In today's marketplace, every real estate agent, every possible referral source out there is extraordinarily important. And they're all being chased after, and you have to know what you can do and what you can't do. And you've got to watch out to make sure that none of the transactions that you're doing can be construed as being a Section 8A or a Section 8B RESPA violation. So those are really big issues that continue on even in this particular environment.
I want to show a couple slides that really relate to what you just said. And price exceptions. I really want to drill down on price exceptions here.
Yeah.
Because this is a slide from a case study of a large lender that looked at loan officers that used MortgageCoach, and the top 25 that used MortgageCoach were 37.5% more profitable than the top 25 who didn't, because they gave less price exceptions. And this is another study. Every time this has ever been done, a MortgageCoach loan officer, I've had some where they were higher than this, but the lowest we've ever found a MortgageCoach loan officer, like when a lender has looked at my MortgageCoach LOs versus my non-MortgageCoach LOs, it's 9 basis points.
Yeah.
You know, so you just gave me an idea. Like, I use those slides all the time for obvious reasons, but you just gave me an idea. I've never used those slides to tie it back into compliance.
Yeah.
And to tie it back in. It doesn't tie to disparate treatment, but I am asking for some advice here. Like, what would be the message when I say that?
It does tie somewhat into disparate treatment, because the reality is, you know, if statistically you took a look at who's getting the price exceptions, you know, protected minority groups get the short end of that stick. And that's just true. I mean, that's been documented for a very, very long time. And that's what disparate treatment is all about. Right? Not treating protected minority groups any differently, you know, and not treating them, you know, adversely as a result of the practice that you otherwise have, which is price exceptions. So it ties back to that as well. I mean, those statistics you just showed, that's pretty impressive stuff. I haven't seen that before.
Yeah, no, it's a fact. I mean, like, I'm never afraid that when a lender has MortgageCoach clients, compare. And the ones that have it, again, it's not just MortgageCoach, it's a more consultative conversation. So when you drive that, MortgageCoach total cost analysis conversation, you're asking better questions, you're giving more value to the consumer, they're going to be less likely to shop you.
And the consumer understands what the price is and why the price is what it is as well.
Good point. So heads up.
I like about your system. Yeah.
I appreciate that, Mitch. So another trend, we're actually getting pretty close to rolling out a reverse mortgage analysis. Yeah. And I'd just love to know any thoughts you have on, HECMs, and, our position on it is we think there's a lot of people that want to look at the difference, like a consumer. Should I do a forward? Should I do a HECM? And we just want to make it easier for the consumer to make that decision. Yeah. But what are your thoughts on that space?
Well, I think it's great space, to tell you the truth. I think the HECM product is a great product. My law firm has been, representing the reverse mortgage industry since its inception, really. And we're counsel to, I don't know if you knew this or not, NRMLA, the National Reverse Mortgage Association. And we've been their general counsel ever since. So, it's a product that we obviously like, because we wouldn't do it if we didn't think it was a great product. It is. Most lenders today have the infrastructure to make these particular loans. I mean, they're licensed because they had to be licensed from a forward perspective. And so they're licensed and they can do things along those lines. The reality is, we're living in an aging population, right? I mean, you look at the demographics, it's, I think, by 2030, 20% of the population will be over 70 years old or so. I mean, there are all kinds of numbers I've seen, 10,000 people a day hitting their 65th birthday, things of that sort. And a lot of people haven't saved enough for their retirement, but they want to stay in their homes. And the HECM product is a very good product for those types of situations where they can stay in their home. They effectively live off the equity. that they otherwise have built out. And I think it's good. And I think what you're talking about doing is interesting to me, because you're absolutely right. The HECM product isn't right for everyone. And the forward product isn't necessarily the right product for some people, in certain circumstances. And if you can do a comparative analysis, and a loan officer has the ability to, number one, originate both of those loans, but number two, sit down with that consumer, and explain the pros and the cons of each one of these loans and how they work. I think that's pretty good. I think there's a lot of value you're adding there.
Well, I couldn't be more excited about this, because not only that, I've, in the process of creating this analysis, we're seeing how loan officers are delivering, their recommendations in their analysis. And let's just say there's a lot of compliance problems. One, you got one loan officer with this Excel spreadsheet, this presentation. One, it's confusing, and two, it's not compliant. So, we think we're going to be bringing something that, consumers need, lenders need, and not only are we going to make it a better sales opportunity for the industry, but we're going to make it a more compliant. So anyways, you're already our counsel. I'm sure our team will be getting your advice on that. Now here's another one. And I love this story, now that, I'm the Chief Innovation Officer for MortgageCoach and Sales Boomerang. I interviewed a loan officer last week, actually, and he got like a cash out alert, where we knew about the family's credit, and the family's credit score was going down. Their credit cards were going up. And when the loan officer called, found out that, this was a family where they had a child in, a really bad health situation. And the mom was literally weeks from, leaving her job and would have been unfinanceable. But because the loan officer used this data, reached out, was able to help the family get a good loan, create a sustainable situation so they wouldn't sell their house. But that's a good story. But data, it's important, but there's also considerations. What are your thoughts and considerations for lenders and loan officers, and how they use data as both an opportunity for consumers, but they do it right?
So data is absolutely critical today. Okay. If you are a loan officer, if you're a mortgage bank, or if you're a loan officer, and you're not working off of data, and you're not analyzing that data, and you're not pinpointing where the needs are, okay, you're going to be behind the eight ball. That's just the reality of it. But the truth of the matter is, and I think this is what you're probably getting to over here, data can be overused, okay? And so you have to watch out about that. Sometimes companies will use data to justify something when it's not really there, or when it's the wrong data, in all honesty. So, from my perspective, when I look at data, it's absolutely critical, but the real challenge is to use data better, not necessarily to just use more data, but to use the data better and to understand what you have. Now, from a compliance perspective, from a legal perspective, I see this all the time. You need to know where this data came from. You need to know what the sources are. You need to know what, if any, restrictions there are on the use of this particular data. I mean, there could be privacy concerns, things along those particular lines. And so you have to, you can't just go out there and buy data without an understanding of what you have, what it is that you're otherwise purchasing. And there's a lot of increased regulation, especially on a state level, that deals with the use of data, and especially from a privacy perspective. Yeah.
Well, I've got one more question before we wrap it up, but I do want to drill down one more question on that topic before I ask the last question.
Sure.
I think we're moving into an era of the haves and the have-nots, and the lenders and the loan officers that are the haves, they're data-driven mortgage advisors. They have data. They're being more relevant. I don't want to knock all marketing and say all marketing is spam, but if you're not really looking at the relevance of when you're contacting a customer, how you're contacting a customer, you're going to deliver more service, better service to that client. And then also, if you're making sure that, hey, like some of these data alerts and these insights, they should just go through an automated marketing sequence. some of those should go right to a family. I mean, excuse me, right to the loan officer.
Right.
So do you align with that? Like the future of lending is data-driven mortgage advisor, and then, well, I know you agree with that.
Absolutely.
What percentage of the industry thinks actually going to figure this out in the next couple of years? Like, is 50%? Like, we've got about.
I think a lot of the industry is going to figure out the need for it in the next couple of years. But I think you're absolutely right when you say we're entering an era of the haves and the have-nots. I'm not sure that a lot of the industry is necessarily going to be using it in the next couple of years in a manner that's appropriate and in a manner that's helpful along those particular lines. But I mean, people are, it's there. It's critical today. It's going to be even more critical tomorrow, quite frankly.
Yeah, and any manager or leader that's listening to this, having the counsel of Mitch Kider to make sure you're doing it right. Having Mortgage Coach, Sales Boomerang, and any CRM that we're integrated with, it's never been more important. So cool. Well, here's my last question, because we're also I'm interviewing a lot more executives this year in 2023. And I've always worked on this thesis that there's always been a financial literacy crisis in America. Like, that's not a new thing. It's been going on for my entire life, and part of and I'm dedicated to putting a dent in that with Mortgage Coach. But there's an affordability crisis in America, and I do think we're going to be doing more things here at Mortgage Coach and Boomerang to help loan officers deliver, CRA loans more efficiently, down payment assistance programs more efficiently. We're even looking at, hey, how can we make it when an alert comes up, we're identifying, is that in a CRA area? But, for lenders to hit the new Fannie and Freddie affordability targets, do you have any specific insights? Do you have any advice? Because it's something that we want to do a better job of as vendors to the industry. But what advice do you have to the industry, and what advice do you have to us?
Well, let me start with a couple of things. There's a lot to what you just asked. First of all, CRA is extraordinarily important, and it's in the process of being modernized. And I think that's a good thing, to tell you the truth, because I think changes need to happen with the manner in which CRA is applied. For example, I think it should be much more technology driven in determining, where you are going to reinvest your loans, as opposed to just geographic in nature. But go ahead, what were we going to ask?
Well, I wanted you to define that. Maybe you were going to do that, but you said it needs to be modernized, and I just want to make sure you unpacked what it meant to be modernized.
Yeah. So, you have to take technology today into account and recognize where footprint areas ought to be, or how that's utilized, as opposed to just having, the old-fashioned 1970s version of where's your footprint right around your branch office itself. So you need something along those particular lines, and you need a more modern CRA rule that gives additional credit, or credit for additional things that help improve, consumer housing, which I think is, these are what are, being talked about out there, expanding beyond simply making the loan itself. Where else are you putting your money, and how are you helping the consumer along those particular lines? So that's real important. But when you talk about like the Fannie Mae and Freddie Mac programs, you have to be making loans to minorities. You have to start getting out there and doing that. And that's not just what CRA is all about. CRA is really putting money back into the communities. It's for depository institutions, really, and it's reinvesting in communities that have given you money. That's what it's about. I'm not really in favor of what I see happening in the states out there, where they're starting to impose CRA requirements on independent mortgage bankers, because they're not taking deposits. So, you can't say you're not taking deposits, but you have to reinvest here. That's not what CRA is really about. It is, you're taking these deposits, so you have to reinvest here. But the other issue that you raised is, affordability in general, and fair housing, and how that comes into play. So in order to meet Fannie Mae and Freddie Mac's requirements, you're really going to have to, for them to meet these targets, you're going to have to market to different minority groups. You're going to have to go into other communities. And that's really important too. You need to know how to market. You have to be inclusive in these communities. You can't just put, every white model on an ad and go into a majority minority area and say, we want your loan business. You have to be a part of that community as well, which is why it's important for lenders to be both diversified in their advertisements and diversified in their employment base as well, so they can show the community who they are. You have to reflect the community itself if you want to get business and you want to get loans out of that particular community. You also have to have the right products. Okay, there is a thing called reverse redlining, right? And that is when you're going into these communities and you're giving them all the wrong products, and you don't want that to be happening either. So there's a lot that needs to be done, and a lot of it is getting in these communities, having a presence there, marketing to the community as a part of the community itself, and educating the community. Financial literacy is, I think, the way you began this particular question, and it's really, really important. And if you want to, as a lender, okay, go make loans in these underserved census tracts, in these majority minority census tracts itself, you've got to be able to go in there and help them and teach as well. And education is critical to it, and it's critical to you getting that business.
So I, again, couldn't agree more. We're putting a lot of resources in this. Before we do closing thoughts, I want to remind everyone, there's a video in the Mortgage Coach YouTube channel, called the Mitch Kider Power of Homeownership Story, which is it's a super inspirational video. You're not going to get compliance ideas from it, but you're going to hear Mitch's story. And guys, it's an amazing American story. I do believe as lenders, like, we can put a dent in financial literacy in America. Like, if every time a first-time family got a mortgage, they got the disclosures, they got quoted rates right, but they got a rent versus own analysis. Like, they would be better off. They'd be better homeowners. If every time someone gets into debt, they got an educational experience that went beyond rate, payment, cash to close. Like, as an industry, we need to go beyond this. So my closing thought, and then I want to ask for yours, Mitch, is that I do believe, like, loan officers can be the most valuable advisors to consumers, like more valuable than CPAs, more valuable than financial planners, like more valuable than realtors. But we need to use the data that we have. We've got the asset and the liability side of the balance sheet. And we need to deliver the education, and we need to go beyond the fee worksheet. So those are my thoughts. How do you want to close it?
I'm just going to piggyback off of that, to tell you the truth. I think you're absolutely right about that. For many years we've heard, talk of loan officers are going to become obsolete, and retail originations are going to go away, and everything else along those particular lines. But as we all know, probably the most important investment for the vast majority of Americans is the investment they make in the home that they buy. And they need a loan officer. They need an educated loan officer, and they need a loan officer that's going to educate them as well. And I think that's critical. And I also think that's a way of working your way through, difficult times like we have right now. Because if you can differentiate yourself and you can play that consulting role with your consumer, you're going to get the business.
Yeah, you just made me think of a great quote. I said something similar to what I'm going to say right now on digital mortgage a few years ago, but I think, like, technology companies are not going to disrupt loan officers, but data-driven mortgage advisors are going to absolutely disrupt loan officers. Like, if you have a company and you are not upgrading your team, and if you're a loan officer, listen to this, and you're not a data-driven advisor and you're a loan officer, like, disruption is coming. You know, that's my thought.
A good loan officer needs to be data driven. I agree with that. That's absolutely right.
So Mitch, how I want to make sure, you know, people, managers are going to see this, C-suite's going to see this. How do they get in touch with you, and how should they follow you? And, you know, how can, you know, they either become customers or get more value from you and your organization?
So you can actually follow me on LinkedIn and on Twitter. On Twitter, it's at Mitch Kider. My email address is kider@thewbkfirm.com.
Cool. We'll put links down below. Are you pretty active on Twitter? I've been thinking about getting a little more active on.
I am constantly tweeting compliance advice and updates on what the federal government's doing and what states are doing vis-a-vis the mortgage industry. So I probably have, you know, I probably tweet 4 to 5 times a week.
Yeah, looks like I got another reason why I need to start paying attention to Twitter more. So, Mitch, you're the man. I really appreciate you taking time to, you know, deliver all this advice and value. Looking forward to the next time, brother.
All right, man. It's good to see you. Have a great holiday.
Take care, everybody. If you got value, give this a like, share it with your leaders at your mortgage company, and take care, y'all.
All right.